Bryce Doty, Senior Portfolio Manager at SILJ Investment Associates, which has about $16 billion in assets under management, joining us today from Minneapolis. Bryce, welcome to the program. Let's start off with that jobs data. I mean, it was obviously a surprise, so I won't ask you if you were surprised, but were you disappointed by it?
It was confusing. I mean, it's odd, and the market reaction, it took a while to sort through it. They're like, okay, if there's no jobs, we don't have to worry about the Fed tapering, so risk on. And then the 30-year yield, after dipping, thinking, it was a bad number, is realizing, well, if the Fed's going to just let things roll, and the jobs rebound isn't really probably in jeopardy. Okay, it's just a matter of when, not if, we get a big jump in jobs. So, the short end of the yield curve goes down because the Fed's going to keep rates lower. But then the long end goes up because they're like, hey, we still are going to have a ton of supply chain disruptions. That's going to create some inflationary pressures. And that's still in the cards to come.
Talk about that inflationary pressure. It was interesting that we saw some wage inflation. How long that lasts, we don't know. But talk to us about whether or not it becomes a reality. We get those numbers for inflation next week.
No, I think we will. I think, when you look at the accretion rate of TIPS, which is based on the non-seasonally adjusted CPI, it's been running over 5% for 3 months running, and it's probably going to keep that up. So I think we are going to get that. From a strategy perspective, as a bond investor, that's the worst news. Good news is bad news to a bond investor, and so we like taking some interest rate risk off the table, short in duration. We like our really short ETF, VALT, VALT. It's other than cash, it'll probably be the most stable part of your portfolio. And then we would suggest freeing up some money and going into where the inflation is really hot, into the shipping. BDRY tracks, that's an ETF that tracks the shipping costs. I mean, it's off the charts, and we don't even have the rest of the world really opening up yet. So we see a lot of inflation pressure to come. It's not going to stay here permanently, but why not make some money in the near term, and take advantage of that?
Bryce, is that indeed what we are seeing? You're seeing yields on the 30-year yield rise 3 basis points, yields on the 5-year falling by 4 basis points. Are you seeing that pull forward to shorten up that duration?
Right, totally. I think you're right on there, because it makes sense to shorten duration right now. You can't really make a whole lot of money in bonds, okay? The yields are low, and any uptick in rates, you wipe out your yield with price loss. So it makes sense to do that. And as you said, everything was up in stock market. There could also be a rotation just going out of long treasuries into stocks. If you're going to take on some volatility, why not get paid for it?
I am curious here, too, about the read that we have. I mean, a lot of people had sort of been following the lead, or at least heeding some of the calls that messages that we have been getting out of the bond market in previous months. It seems like over the last 4 weeks or so that it was the equity market that seemed to be getting it right, at least with regards to how they were viewing the economic picture. I'm wondering if you see a disconnect between how the two sides are viewing this economic recovery and how it should be priced.
No, I agree. The money has to go somewhere, and a lot of it's coming off the sidelines. And if you have to pick between the stocks and the bonds, you're going into the stocks. The bond market is a little bit challenged by not just inflation pressure, but by the Fed continuing to print money. If they're going to keep printing money, $120 billion a month longer after this employment report, all of a sudden you see gold and cryptocurrency pop and all those other areas in addition to the stock market. I'm fascinated by crypto, but I got to tell you, a more understandable investment for me would be another ETF, SILJ. It invests in mining companies, gold and silver mining companies. That I get. The price of metals go up, their profits go up. You can make money off of that, and it's a little bit better option and a better hedge against the infinite money printing that the Fed's on. With all due respect to Kashkari, I mean, basically, as an investor, the comments that he makes are that, okay, they're just going to keep printing money. And that's fine, but let's find a way to profit from that as investors. And I think that's one way to do it, is going into SILJ.
What about the commodities at the moment? But of course, I mean, you're sitting over the fixed income space. Is there anywhere in fixed income that has any juice left for you, Bryce?
There is. We actually like the closed-end bond fund space, because the closed-end bond funds can actually utilize a little bit of leverage. If the Fed is going to keep rates low, I mean, repo rates are down to 0.25% for certain securities. I mean, you can obviously borrow at 0.25% and make a better yield in other bonds there. So we're looking at closed-end funds that are making 5 to 6% yield with a duration that's a lot shorter than the aggregate bond index. We're thinking like 3 to 4 years instead of 6. That is a much better trade-off. It's so hard to find an option in the bond market or an investment vehicle that has more yield than the duration, than the interest rate risk. And that's just one pocket that is really attractive to us.
Giving us all the specifics. Bryce, we love it. Bryce Doty, stay well. Have a great weekend. Senior Portfolio Manager at SILJ Investment Associates. Meanwhile, coming up.